The stock market crash of 2022 just kicked into high gear with 3 intense days of non-stop selling. The year-to-date returns of the S&P 500 is down 16.5%. You have the NASDAQ down 25.7%, and you have the Russell 2000 down 21.3%. That means the NASDAQ and the Russell are both in bear markets. The S&P 500 down 16% is in correction territory on the verge of a bear market. Now, when we go back in time and we look at when the economy is in a recession, which is 2 straight quarters of back-to-back negative GDP growth, which we already have one of, plus a stock market and bear market correction territory, the average sell-off is about 39%. With the S&P 500 down 16%, we're on course for about a 40% sell-off on the year. Now, does that necessarily mean we'll get to 40% this year? No, this is something that could extend it into next year, and that's where we would meet the target price. And you got to remember too, these are averages. So 39%, that means there's been some worse, some less, and doesn't necessarily mean we're going to peg that 39% mark. It could be far worse. Like, it take 2000. NASDAQ sold off 87% off of its all-time highs. And the bubble that we had back then is nothing compared to the bubble that we're in right now. So with the indices completing 5 weeks of straight selling on the weekly chart, something we haven't seen since 2011, are we setting up for a dead cat bounce, a counter rally, or is the market bottom end? Or should we just expect more selling from here? Heck, 2011, we had 8 straight weeks of selling. 2008, during the middle of the Great Recession, we had 6 weeks of selling. I'm going to go over all the charts. We're going to go through the technical analysis, and I'm going to give you my insights into what I'm seeing on these charts. But first, make sure you pound the like button and subscribe to this channel so you can be notified of when I'm doing these live streams on Wednesdays and the multiple videos that I do each week. And click the join button down below where you can get all of my market research each and every day. Now, let's get into the SPY chart here. We actually just confirmed today a head and shoulders pattern. It's been resilient up until this point of not confirming it. But today was a little bit different. Here you have the left shoulder, you have the head, and then you have the right shoulder. The neckline is a little bit at a slanted angle, but following Friday's close right on this neckline, it actually broke down below it today with a gap lower. Oftentimes of what we have seen since the 2009 bottom is that these head and shoulders patterns will bounce hard off of this head and shoulders neckline. This time around, it didn't do that. Instead, it gapped below it and it kept on running. There's also a declining channel on this chart, and I thought there was a good chance that we might actually see some decent bounces just as we have in the past off of this declining channel. But so far, that has not been the case. Here you have the upper channel band, and then you have the lower channel band here. But instead of us actually bouncing off of it, as we've done numerous times before, we broke through it today. So you almost have to throw that out the window unless, and it's too early to say this channel band is actually expanding to take into account the actual lows from February. If that's the case, then we may be setting up for a bounce here in the coming days. I'm not sure yet, and I don't like the idea of calling bottoms on the market, especially when the previous support levels didn't hold. Then it starts to become, okay, we're form-fitting to the charts to see what we want, and that's not something that I want to do. There's also some long-term support levels that I think we need to go over here. Both of them actually go all the way back to 2009. The first one here takes into account a number of previous peaks. And what's happening here is we're actually testing it. So it started back in 2009, and we have seen multiple occasions where price has topped out at this resistance level. Now, after the 2020 bottom, we blew right through this resistance level instead of selling off like times before. But now you have price returning to this price level. So at about $396 a share, you're going to get a test of this level and whether or not it can hold. The second level is a lot more problematic. There's not a lot of support underneath for anything else beyond a retest of price support at 300. This isn't in the here or now. This is something that we might start seeing later on in the year if the sell-off continues to accelerate and you have Jay Powell continuing to be hawkish and raising its interest rates and do quantitative tapering. So these are the two support levels. Can we bounce off of this in the coming days? If not, it sets up a scenario where we could see a 300 on the SPY before year end. Because with this dramatic rise off of the 2020 lows, the constant support from the Federal Reserve during that rally did not create much support for the market underneath. Now you're thinking to yourself, maybe the Qs are a little bit better. No, it's far worse. Remember, they're down 25% year to date. Yes, you would think that a bounce would be in the cards here in the near term, not necessarily a bottom, but a bounce. Remember, in the bear markets, there's a lot of counter rallies that can provide some good long opportunities, even if it's just for a short period of time. You have to be very aggressive on the profit taking. Again, with the Qs, you had this declining channel that looked even better on the NASDAQ than it did on the S&P. But the problem with this, just like with the S&P, is we actually broke below this channel today. So it becomes much more problematic going forward. Where is the bottom on the NASDAQ? Because it's not bouncing off of this lower channel band as it has done in the past. And that becomes a huge problem for the bulls going forward. Now, we're actually testing a much bigger support level going all the way back to 2020. And this support level is getting tested today at about 297. If this level can hold, which it has tested and held many times in the past, there's an opportunity for a dead cat bounce. But the key with any kind of dead cat bounce is not to try to bottom tick the market. You try to get the meat and potatoes. You don't need the appetizer and dessert. Stick with the meat and potatoes of the rally, that middle section, that middle chunk of the rally. Let other people try to time the bottom. You don't have to do that. So if we can get a bounce, maybe there's an opportunity for a nice little rally here of 5 or 6% just to relieve itself of some of these selling pressures. Now on the IWM, we have this bear flag pattern here that confirmed a couple of weeks ago. And since then, it has been consistently selling off. And if you go back all the way to 2018, I have been calling for a potential retest of this support level. It's just how the technicals were shaping up to be. It wasn't anything grandiose on my part to thinking that I had a crystal ball, but there was no support underneath, and it made a lot of sense for it to eventually come down to this like 168, 169 level. Now, if it can come back down to it and hold it, that would be a significant bounce opportunity for IWM. But again, you got to let the bounce start to unfold first, get a little bit of a confirmation there that it wants to bounce, and then play it from there using risk management. And if it does bounce off of this 168, 169 level, you have to contend with this declining trend line here that's already in place. And so that would only probably take us back up to somewhere around like the 190 to 195 price level. These are some of the most precarious times that we've seen in a very long time in the stock market. There's this tendency to want to call the bottom, to want to call the tops, to be the hero, to continue to trade throughout, hoping that you can nail that bottom so you can brag to your friends that, hey, I bottom ticked the market. But the real success stories in the stock market are those who let the price action come to them. Not forcing trades, but having trades forced upon them when it becomes obvious that when a bounce attempt is trying to form and that you can play it with a good reward to risk ratio, that's the time that it becomes ideal. Trying to catch a falling knife, or in this market, it's like trying to catch a dozen falling knives, is not ideal. And with the Fed just getting started really on these interest rate hikes and not even starting the tapering yet, things could get a lot worse. We always talked about don't fight the Fed when they're dovish and the market's going up, but it also goes both ways. Don't fight the Fed when they're hawkish and they're tapering. My trading portfolio is 100% cash right now. I have no positions. I'm hoping that can change in the next few days, but I'm gonna let the price action come to me. I've yet to add a new position in the month of May. January through April has been great, but right now I'm sitting in cash and I'm completely fine with that. And if I do take a long position in the market and I don't get stopped out on it, then I'm gonna be very aggressive on the profit taking and looking for that re-entry to the short side in the days that follow. If you enjoyed this video, remember, pound that like button. Subscribe to this channel so you can be notified of future videos. And let me know down in the comments below, how are you faring in this market environment? Have you just given up? Are you throwing in the towel, or are you buying the dip? Or are you, like me at this moment, sitting in cash waiting for better opportunities to get long or short going forward? Let me know down in the comments below. Thank you guys, and God bless.